Right now, somewhere in the world, a retail trader is watching $14,000 vanish from their account in real time. Their heart is hammering against their ribs. Their palms are sweating. Their brain is screaming at them to do something, anything to fix it. So, what do? They double down. They enter a larger position to try and win it back, and within 3 minutes, their entire account is completely wiped out, gone. They didn't lose because their strategy was bad. They didn't lose because the market was rigged. They lost because they didn't know the 5-minute rule. In the next 60 seconds, I'm going to give you the exact psychological blueprint that separates the top 1% of institutional fund managers from the 99% of retail traders who lose every single dollar they own. This single rule does not care about your technical indicators, your chart patterns, or your macroeconomics. It is a hardwired psychological circuit breaker. If you do not install this circuit breaker into your trading routine today, the market will eventually find your breaking point and it will destroy you. Let's look at the brutal truth of what is actually happening inside your brain when you trade. Section 1. The psychology of the trade slaughterhouse. Every single time you open your trading platform, you are entering a psychological slaughterhouse. The human brain was evolved over millions of years to do two things extremely well: seek pleasure and avoid pain. It was designed to protect you from saber-toothed tigers, starvation, and physical threats. It was absolutely not designed to handle electronic financial speculation. When you enter a trade, your brain does not see numbers on a screen. On a deep subconscious level, your nervous system interprets floating red numbers, unrealized losses, as an active existential threat to your survival. Let's map out exactly what happens when a trade starts going against you. The moment price action ticks past your stop loss, or the moment you decide to manually hold a losing position because it has to bounce back, your prefrontal cortex, the logical, rational, decision-making part of your brain, completely shuts down. Power is instantly diverted to your amygdala. This is your brain's alarm system. It triggers a massive flood of cortisol and adrenaline into your bloodstream. Your survival instincts kick in. Your body enters a classic fight or flight state. But here is the trap. In the financial markets, your survival instincts are your absolute worst enemy. In the real world, if you are attacked, you fight back or you run. In the trading world, fighting back means revenge trading. It means adding to a losing position. It means increasing your lot size to force the market to give you your money back. Running away means freezing up, pulling your stop loss further down, and refusing to accept the reality of the loss until the broker forces a margin call. This is what psychologists call the amygdala hijack. When you are in the middle of an amygdala hijack, you are legally insane. You are incapable of processing probabilities. You are incapable of following a plan. You are operating purely on raw, primitive, terrified emotion. The market is an absolute master at exploiting this exact state of mind. It is designed to create maximum pain for the maximum number of people. It lures you in with a small win to make you feel invincible, triggers your dopamine receptors, makes you over-leverage, and then violently reverses to trigger your panic receptors. If you trade immediately after experiencing a sharp loss or an overwhelming win, you are not trading the market. You are trading your own neurochemistry. You are playing a game of Russian roulette where the house always wins. Professional traders understand that managing your capital is secondary to managing your internal biochemistry. If you cannot control the chemicals pumping through your veins, no algorithm, no indicator, and no mentor can save your account. Section 2. The anatomy of the 5-minute rule. This brings us to the core mechanism of survival, the 5-minute rule. What is it? The 5-minute rule is a strict, non-negotiable operational protocol that states the moment a trade is closed, whether it is a massive win, a devastating loss, or a minor scratch, you must completely close your trading platform, stand up from your desk, and walk away for exactly 5 uninterrupted minutes. No looking at your phone, no checking Twitter or Discord to see what other people are saying. No checking the chart on a different time frame to see if you would have been right if you stayed in. Complete absolute disconnection. This sounds deceptively simple. When retail traders hear this, they laugh. They think, how is walking away for 5 minutes going to make me a profitable trader? I need to learn advanced order block theory. I need to understand liquidity sweeps. They laugh all the way to a blown account. Let's break down the precise anatomy of why this rule works and what it does to your physiology. The 5-minute rule acts as an artificial cognitive reset button. It's a psychological circuit breaker designed to interrupt the emotional feedback loops that lead directly to catastrophic account drawdowns. When a trade closes, your brain is highly unstable. If it was a loss, you are feeling pain, rejection, and an urgent desire to fix the mistake. If it was a win, you are feeling a massive rush of dopamine, euphoria, and an artificial sense of invincibility. Both states are equally dangerous. Euphoria makes you reckless. It makes you take trades you shouldn't because you feel like you can't lose. Pain makes you desperate. It makes you take trades to break even. When you step away for 5 minutes, 3 critical shifts occur. Hormonal clearance. It takes roughly 90 seconds for an emotional chemical reaction to completely flush through your bloodstream if it is not continuously re-triggered. By walking away from the stimulus, the flashing charts, you allow your cortisol, adrenaline, or dopamine levels to normalize. You give your nervous system the time it needs to exit the fight or flight response. Re-engagement of the prefrontal cortex. As your biochemistry settles, blood flow returns to your prefrontal cortex. Your capacity for logical reasoning, risk assessment, and long-term planning is restored. You stop viewing the market as an opponent to beat and start viewing it again as a statistical matrix of probabilities. Breaking the habitual loop. Human behavior runs on loops: cue, routine, reward. The cue is the losing trade. The automatic, primitive routine is to click buy or sell again instantly to seek the reward of breaking even. By physically moving your body away from the computer, you shatter the routine. You introduce a massive friction point between your emotion and your execution. Section 3. The 3 deadliest traps it destroys. To truly appreciate the power of this rule, we have to look at the 3 specific, fatal trading traps that it systematically destroys. These are the 3 horsemen of account destruction. Trap 1. The revenge trade escalation. This is the classic retail death spiral. You take a perfectly valid trade based on your setup. The trade hits your stop loss. You lose $200. You feel a sting of annoyance. You look at the chart and you see a massive green candle moving in the opposite direction. Your brain says, "Ah, look, it was just a liquidity hunt. Now it's going up for real. If I buy right now with double the position size, I will make back my $200 loss and make an extra $200 profit in 2 minutes." You enter the trade, price immediately stalls, reverses, and tanks. Now you are down $600. Your panic spikes. Your logic completely evaporates. You enter a third trade, massive leverage, shorting the market out of pure anger. The market bounces. You are down $2,000. Within an hour, weeks or months of disciplined gains are entirely deleted. How does the 5-minute rule destroy this? If you step away for 5 minutes the moment that first $200 loss hits, you are not at the desk to take that second impulsive trade. By the time you return, 5 minutes later, that temporary volatile price action has already played out. You look at the chart with clear eyes and realize that taking a trade there would have been pure gambling. You saved yourself thousands of dollars simply by doing absolutely nothing. Trap 2. The winner's illusion, overconfidence. Everyone talks about managing losses, but almost nobody talks about the danger of winning. You have a phenomenal trading day. You hit 3 take profits in a row. You made $3,000 in 2 hours. You feel like a financial god. You look at your screen and think, "I have completely mastered this market. The setups are so clear today. Let me find one more. I'll increase my risk because I'm playing with house money anyway." This is the exact moment you enter the danger zone. House money is a myth. It is your money the second it hits your balance sheet. Overconfidence causes you to relax your entry criteria, ignore your risk parameters, and take messy, disciplined unsetups. You enter a bloated position, the market delivers a harsh dose of reality, and you give back the entire day's profits plus some of your seed capital in a single sloppy trade. The 5-minute rule forces a mandatory pause on your ego. It forces you to step away, cool down, and realize that a winning trade does not mean you're a genius. It simply means the market's current distribution of probabilities favored your strategy in that specific moment. It keeps you humble, and humility is the only way to stay alive in this game. Trap 3. Cognitive overheating, the fatigue bleed. Trading requires immense cognitive processing power. Your brain is constantly calculating risk ratios, analyzing multi-time frame structures, monitoring order flow, and managing emotional tension. This